Welcome back to another YouTube video here at Cozy Financial Planning. We've already talked about traditional investments. We've talked about real estate investments. Now, how do they compare to one another? A lot of people have discussions with me throughout my tenure as an advisor, and everyone was always discussing like it's an either or situation. So let's take a look at them, pros and cons, and we'll kind of weigh them together and we'll see what we come to. Let's get right into it. So when we talk about traditional versus real estate, let's talk about the real estate first. We'll go over some pros and cons for both sets of them. We'll keep it as general as we can, and then we'll compare the two. So one of the first things is our pros. I won't go into depth on these necessarily because I've already done a video on that and you can check it out in the playlist and it'll be there. So some of the pros that we have are rental income. You have a passive amount of income coming in every month, the difference between your mortgage and whatever you charge for rent. The beauty part about that is, as an aside, is that continues to go up over the length of time, right? When you renew your mortgage, hopefully it's lower or significantly enough lower. And your mortgage, if you haven't increased your rent, you're still gonna have a gap. And if you increase your rent, it's that much more, right? We have a tangible asset. It's physically there. You can visit it, you can touch it, you can feel it. It appreciates over time. It's kind of a longer term plan. You have control. You get to decide on renovations or how it looks. You have tax deductions. Not everyone knows all the ones you could use. Definitely recommend talking to an accountant about which ones. However, there's a lot of unique ones you can use depending on how you got the money for the down payment, where it is held, all that kind of stuff. But that's kind of getting to nitty gritty of it. Happy to talk about another time. But for now, you just have tax deductions on the pros list, right? You have leverage. You can definitely leverage your property, especially if there's equity grown in it, to get more property, or just generally have one or to do renovations or anything else you'd like to do it. Now, for the cons list, we have a big upfront cost. The entry cost into real estate investing is higher than anything else. You need to have that down payment. No matter how you get it, you still need in the tens of thousands of dollars generally. It's hands-on. It is more involved than stocks or traditional investments. What that said is some people have told me they'll hire a property manager. However, that does cut into your profit. It is costly. You still have to pay for anything, even if they can't do it. And they're still going to refer to you and talk to you about what yes or what no. You may not be the one getting the 3 a.m. phone call in the middle of the night for the plumbing issue. Your manager probably would, but you're going to pay a premium to have that sleep, right? And then you still have to deal with the problem in some form or fashion. The other part is it's the market risk. There is some market risk to it. Not liquid, so it means that you can't sell this overnight. This is part of the appreciation portion of the pros, in my opinion. It is generally set as a 20 or 30 year investment plan. It is a financial plan that's kind of sticky. It's not liquid. You really need to see that equity grow and get that out of it to really make it bank. The income is fantastic and it does work very well. However, the equity portion really puts the icing on the cake for it to be a full financial plan if you're using real estate as your investment vehicle. Interest rates do matter because you can't, sometimes if you're rent controlled areas, you cannot increase your rent as high as your mortgage might go up based on interest rates for a renewal. So you do have that offset and it can be a little iffy. You just have to be careful of it. I'm a believer that real estate does work for everyone or can work for you depending on your situation. You just need to find out what's best for you and your family and make that choice for yourself. Now, I will say one thing about it is that I do know a lot of people who've been in real estate investments and they maybe broke even after having an average result, such as, they got real estate agents to bring in tenants and they still had problems. Destroying property. I've heard of tens of thousands of dollars worth of property damage and they just leave and nothing happens to them. A lot of issues with tenants leaving or a lot of issues trying to remove tenants. Cash for keys is a thing, but I've known people pay that and then the person still didn't leave. So there are potential headaches and you have to consider them. And I don't believe anyone should consider that they'll never experience it. That's not going to be me. You really need to consider if any of this is important to you and how you manage it, right? Now, like I said, it is a very good thing. I will add an additional con to real estate in that it is very good for set it and forget it. If you have a property, yes, you're still thinking about it, but the appreciation portion of it, kind of you set it and forget it. Real estate does fluctuate every day, like it does, like the stock market does. It can and it will fluctuate on a regular basis. However, because it's not reported on a daily basis, like you can see the tickers every day on the news channels, it's, you kind of just put in the back of your mind. You never think about it until maybe once a year when you get an appraisal or you think about it. I have friends that bought houses. They saw a great increase in the first few years of owning that house, and then they plateaued for the last like 4 years, which is great. It's still plateaued. It's still going up. It still has gone up, but it hasn't gone as much as it would continue to go, because it's insane to think they're always going to go up forever. And it hasn't really gone down, which is fantastic too, but it doesn't mean that it doesn't fluctuate in some capacity on a regular basis. And you just have to be mindful of that. I think it's a good benefit that you can kind of set it and forget it in a manner, and it not be so in your brain about up and down. I think that is very good for your investment. I do know a lot of people have gone up and down just by a few $100 in their investments, and then they will call their advisor and get very nervous. And then maybe they need to consider, is that the best investment for them? That's a different conversation and not one for today, but we'll move on. So we're going to traditional investments here. When we talk about traditional investments, we're including GICs, bonds, mutual funds, and stocks. I'm not worried about everything else, but I'm just going to stick to these for the comparison just to make it a lot easier. Those are the general ones you have. Yeah, T-bills can be considered in there too, but however, they're just not utilized as often as they maybe once were. So we'll kind of push aside, but they kind of work similar to GICs or on the very conservative side of things. So the pros for traditional investments start with easy to buy and sell. You call someone up or you go online on your phone, on your app, and you just buy and sell. It's very, very simple. Can be done, like I said, over the phone, over the internet. It's very straightforward. And there's, no barrier to entry. It's very simple, right? You can put in your minimum, whatever it is for a mutual fund or a GIC. So $50, $25 in some cases, maybe 100, anywhere it ranges for anyone's entry point. It's very easy to use. It is passive. You don't have to worry about tenants. You don't have to worry about real estate agents putting someone in. You don't have to worry about that phone call at 3 a.m. for plumbing. Completely passive. Everything goes through. You might have to have a meeting once a year. However, to reinvest your GICs because they come up for renewal, or you have to have a diversification, or just to talk to your advisor, talk to someone about mixing your investments again, your mutual funds and your stocks, to make sure everything is still fit for you and your risk tolerance, and you kind of move on from there, right? It is long-term capital and appreciation. It makes a lot of sense. It can grow. Mutual funds or stocks are more for that than bonds and GICs, but those do work as well. They're just not as fast. It's diversified, or it can be diversified. Specifically, mutual funds make it nice and easy. It's like a one pill fits all in that case. And then there's automatic investing. You can just have it automatically come off your paycheck if you wanted to, and just automatically go right into it. It's very simple to keep investing, so it's another set it and forget it ability, and which is very good for for yourself and your financial planning and reaching those goals. Now we have the cons. So there is a lot more market volatility with stocks and mutual funds in particular, and bonds to some level. GICs are guaranteed investment certificates, so they're okay. There's less control. You don't have control over the companies that you're investing in. You don't have control over the companies you're using, the financial institutions you're using, or the apps you're using, and things can happen. They can change things. I know there are some in Canada that talk a lot about fees, and then they start charging you fees if you're dormant. So there are always ways for them to make money, right? They're always looking for ways to do that. There are a variety of returns. GICs and bonds are lower generally than mutual funds and stocks. In general, you can, for anyone questioning, there are like corporate bonds that go really high, or other ones, in foreign bonds can be very high. However, there's also not necessarily a guarantee that they're going to pay out, because sometimes the reason why they're so high is because they're kind of coming after for trying to get money for a reason, right? They might not have enough to pay back. And that's fine. Things are what they are. These do require patience, just like the appreciation for our house. These do require patience. They do work together. You need to see the ball roll, especially when it comes to mutual funds and stocks. If you're starting slow, if you're putting $50 a month into a mutual fund, you're only putting $600 in the first year. You may not feel that's much of anything, but I believe it's a great step for you if you're starting out, and you kind of move on from there. The fees are attached to mutual funds for the most part. There are no fees to bonds and GICs usually. And then there's Sometimes there's a fee for buying and selling in stocks. Well, there's always a fee for buying and selling stocks, but sometimes there's a broker fee, but they're negligible. And you can do it online now, so the broker fee is very limited or virtually non-existent, depending on how much money you're putting in and how many you're doing on a regular basis. Again, fees are generally allocated to mutual funds on a regular basis, but they are passive, and it is someone working for you to make sure it's diversified and the money's working hard for you generally. So I hope everyone kind of got that from the pros and cons for both, kind of what they are. Now, let's take a quick summary of this, and then we'll talk a little bit about it in depth. So we have a quick summary of this, real estate and traditional investments, on what they work on or how they work. The risk levels vary, medium to high and low to high. I think real estate can be a little lower, but this is probably not something what you were sold as, that real estate's a high investment risk. And it is, because, and the reasons are, it's a physical building that you need to take care of and maintain. You still are not guaranteed your passive income, because tenants can come and go and you may not have to fill that, and then you have to pay for your mortgage for that month. You still have big expenses to pay for, and yes, you can write them off. However, you still need to pay for them up front. You still need the cash to put a roof on your house when there's a leak or a problem. And even then, before, like, you might have to deal with insurance, but let's just normal repair. You have to put the roof on the house before you get a tax deduction for it, right? It could be upwards of 12 months. So it's not like instantaneous. The other one is it's still a physical building, right? You still have to own that building. You're leveraged. It means that you may not be able to get a loan for something else you might need, like a car, or pay for, if you want to buy another property, or have trouble requalifying for your own mortgage. It could be, and not saying it does happen, but you do have to be mindful of these things. It's not as simple as everyone thinks it is, that super low risk, and a lot of people think there's no risk to real estate investing, and there absolutely is. And the more you have that have mortgages on them, the higher that risk comes up, because you become more and more leveraged. And we already talked about the traditional investments risk, low versus high, GICs, stocks, they can all vary. So it's what's best for you, right? Where you fit in there. There's a lot more high effort required for real estate because of the hands-on. Even if you're dealing with a property manager, you have to deal with that property manager. You have to buy or give the money and think about it. Like I said, getting the roof on the house. Maybe you need to supply your tenants with snow shovels and lawnmowers. You got to make sure it's all up and running. So there's more effort. Low effort on the traditional investments, because you buy through a broker or just kind of automatically invest, and you might have a once a year meeting for a couple hours, kind of take your time out. The liquidity is low on real estate, as we've already discussed. It's very high for mutual funds, mutual fund stocks and bonds are very high. GICs, you can unlock them, but they're not common. They do come up just for whenever you set it, right? But generally speaking, they're probably medium to high. Income potential is much higher for passive or for the real estate, because it's always coming in monthly as long as you have tenants. And it's moderate, in my opinion, for the traditional, because you have dividends and interest, and you don't always generate them, and they may not be a lot depending on what your goals are for your investments. If it's growth, you're probably seeing very little dividends and interest for the start, and then as you get older, you might be getting more of that. Growth potential, I think, is very high for both. We have mutual funds and stocks, and then we've got just the appreciation of property in Canada generally does pretty well on its own. The costs and fees, upfront and ongoing. The upfront cost is probably the biggest one for real estate, and then you've got some ongoing ones, but they tend to be more limited. As long as you have tenants, it can spike some months because you might have to fill your house or pay your mortgage when it's not full, and you don't have tenants paying. And what happens if the tenant is not paying and still there? You don't even have the chance to come up with that, so you got to figure it out. And this kind of goes to what I said earlier about knowing people that had problems with this. One of the things is they ended up selling a house because they were almost underwater, and they broke even. They didn't lose, but they broke even. But technically they didn't break even because they lost a decade of opportunity cost. If they had just been in stocks or mutual funds, it's likely, because of COVID and everything, they would still be up or have the potential to recoup that. And because they had to get out because the mortgage was too much, and they didn't have tenants, and they were being buried because they have too many properties, they didn't have a chance to come out without somebody else sinking money into the house for them, or them coming up with a dramatically tens of thousands of dollars of windfall. So again, there's that risk, and then there is that cost, and that happens. It does happen. It's just average, right? Now, low fees is kind of a misnomer for the cost of mutual funds or traditional investments. They're relatively low, but it can get up there if you're doing a lot of trading. Stock prices, like, a lot of trading, you can get up there in prices. $10 a trade is a lot if you're doing it often. Mutual fund fees aren't terrible. Try to aim for around 2% or less kind of thing. We can have a whole conversation about fees, and we likely will at some point. They're not the end-all be-all of investing or financial planning in particular, but they are something to be mindful of. Now, with the house, you have full control. It's yours. You buy, sell it. You get to rent it the way you want, make it the way you want. It's yours. You will own this. And then on the other side, you have some control, just very little. GICs, once you're locked in, you're locked in. There's no control over it, right? Bonds, same thing. Once you're locked in, you're locked in. You have no real control over it. You can buy and sell it, but there's no control. Mutual funds, you don't have control over what you're investing in. They do all the investing for you, but that is why there's a lot of options available to you, and you just have control over making sure this is set for you and your financial plan. That's what's highly important about this. Stocks, you have, again, very little control over the fluctuation of the companies. You just get to pick and choose them, and you do have higher control over a stock portfolio, I do believe. With all of that said, this isn't an either-or situation. This is something that you would do jointly if possible. I look at real estate as just a different asset class. So if you have mutual funds, you have stocks, maybe you have bonds or GICs, maybe real estate's an option for you. Just make sure you do your due diligence on the program that you're getting into. There are some people out there that are trying to take money and say, oh, we'll give it back to you, like private lending. That is possible, but the problem with that is, and the caveat you need to think of is, there's a reason why that person is asking for private money to fund their real estate program or their development. It's because the traditional place isn't willing to give them more money for whatever reason, and they're offering a higher interest rate. Like, why would somebody pay you a higher interest rate if they can get a lower interest rate at a bank? It's kind of counterintuitive to what they're doing. So just be mindful and be careful. Not saying it doesn't work. It absolutely is possible to work. I do know lots of people have done it. I do know organizations that do it for private people. They come in and find all these individuals. But just be mindful that, just be careful with it. It is, the higher return is a higher risk to it. Just be mindful of that. If you want a taste of both, and I may have mentioned this in a previous video, but if not, real estate investment trusts, REITs, they're called REITs. They generally invest in like smart shopping centers. Sometimes they'll do private residences or buildings or anything like that to rent out. So it gives you a taste of being a landlord without actually having to be a landlord. And you have the benefits of a mutual fund in a lot of manners as well. It's kind of pretty good for best of both worlds. And it's something to consider if you're looking into real estate, you're not sure about jumping right in. It also gives you that lower price point to jump in if you don't have the upfront cash to buy your own property. So like I said, pick the best one for you and your family and your actual financial plan. Go through my videos, look at how to do your financial planning for yourself, and then apply this. Figure out what's best for you. Once again, thanks again for joining me for another video of Cozy Financial Planning.